One of the things that's super rare in a company, but really good if you can find it, is whenever the company name has become the noun or verb associated with whatever product or service they provide. Google is an obvious example. You ask somebody to Google something, they know that means search. Uber's another one. You don't ask somebody, hey, are you ride sharing to the airport? No, you say, are you Ubering to the airport? And that shows what kind of a moat they have. Now, this was laughed at by the value community whenever it IPO'd because they were losing a few $1 billion a year. But it's kind of snuck up on us, and I think there's more to the story here, so I wanted to explore that. To do that, I'm using the parttimeinvesting.net software, which I created because I was sick of all the other super expensive financial websites that all they do is flood you with stock price information, news, analyst updates, that sort of thing. It's nothing about the underlying fundamentals and valuing the company. So I wanted to create something that was truly based around looking at a company, doing a deep dive into the financials, making valuations that didn't just spit out one number, but spit out a distribution, and something that did it a lot cheaper than these financial sites. It's easily paid for itself with me. And it was probably a little bit of luck as far as timing goes, but I wouldn't have had the conviction to do some of the stuff that I've done recently without this website. So I encourage everybody to sign up. There's a 14-day free trial, which is a long time, so check it out. Anyway, let's get started. One thing that's interesting about Uber is that Bill Ackman has a big holding. I think it's like a $2 billion position, 30 million shares or something. And he's obsessed with high cash flow generative businesses. And I've noticed he doesn't really mind paying up on the PEs as long as it's generating a lot of cash, and it seems to work pretty good with something like Chipotle, right? If I go to the cash flow statement, you can just see kind of what I'm talking about. So operating cash flow, look at this. They IPO'd and they were losing money. Minus 3 billion, minus 1.4, minus 1.5, minus 4, and then didn't turn positive operating cash flow, not even free cash flow, until 2023. But since then, they've just been rising. I mean, if you look at this growth from 2019 to now, it's crazy. And what's really neat about Uber is that their free cash flow tracks almost perfectly with their operating cash flow. So you can add another metric here. I'll put free cash flow on the screen too, put them on the same scale, and you can see how close they are. That means they really don't have a lot of capital expenditures. And we're going to get to this in the valuation section, but just if this growth continues, this is a no-brainer investment, right? It's more about what happens if it doesn't. So for the balance sheet, I have total assets and, it's growing, that's fine, but that doesn't really tell you much in isolation. I like to look at either assets and liabilities on the same graph, which I could do, but I'm just going to pull up common stock equity. So where's that? Yeah, right here, common stock equity. And if I look at it on a quarterly basis for the last 10 years, it's growing, but recently it's dropped. It's dropped from about 28 billion to 24 billion, which is a little bit spooky because it's weird that you would be making that much money, that much free cash flow, and dropping common stock equity, right? I mean, if you're making money, it has to go somewhere, right? Diving into this a little further, and this is what the tool allows you to do instead of sifting through a bunch of financial statements and stuff. Here's their revenue. We'll go look at their net income, and I'll do rolling trailing 12 months because I love putting stuff on rolling trailing 12 months because it just smooths out the curve. Yeah, big drop there. So what I'll do is go look now at free cash flow and say, hey, look, were these actual cash expenses or was this like a paper loss type thing? So if you go to cash flow, you can compare operating cash flow. Yeah, it's a nothing burger on operating cash flow, which makes me think it was some sort of write-off or, it's less of a concern after seeing that, right? So let's jump into valuation. What do I want to use for my free cash flow here? How do I want to value this? Well, I'm going to go to my custom metrics, and one of the things I did was create this adjusted free cash flow per share. And you can create your own metrics here with all of the financial statements. If you want to make some crazy thing with, seven different items in it, you can do that. This one is literally free cash flow minus stock-based compensation divided by number of shares. All right. And I just like to do that because it catches somebody who's doing a bunch of stock-based compensation, So anyway, we're right at $4 a share, $3.74. I'll just do 4 for the valuation. Look, it's much different than this 4.77 up here. So that's why those custom metrics are helpful. So if I do 4 for starting free cash flow, growth rate. All right, so another thing, I'm going to go back to the cash flow statement, the operating cash flow, and we have this neat CAGR calculator down here. Now, they have to have the same sign. So if I look back, rolling trailing 12 months, and I do 2024 to 2026, look at that growth. That's 52% per year. That means that they're more than doubling. Yeah, they went from 4.3 to 10, so more than doubling every 2 years, let's say. If that continues, it's a no-brainer, right? I'll put that in. I'll put like 50 to 52 and just show you what it looks like. 50 to 52, even with no long-term growth. I mean, you're looking at easily a $200 stock today, if that's the case, okay? Now, that's a big caveat, right? I mean, if you think that they're going to grow at 52% for 5 years, that's I don't think that's realistic. That would be them making $32 a share in free cash flow, so that's kind of crazy. But what is realistic, right? So if I look at their revenue and go back to, let's say, 5 years, or let's look at 10 years. The revenue's growing the last few years, let's say from 2023 to now, they've grown from 30 to 50. So in 3 years, grown about 20 million. And let's just say that kind of continues linearly and not exponentially. Then you're looking at, in 5 years being, let's see, another 20 plus 10. So maybe to $80 billion of revenue. And what sort of free cash flow margins are they making on that? Well, we can go to, let's see, free cash flow margin, custom metric. They're making roughly about 20% on that. 20% of 80 billion is 16, but I'll do it like this. 80 times 0.2, 16 billion. And they have 2 billion shares outstanding. So that's $8 a share. So if in 5 years they got to 8, what does that look like? Well, that's doubling in 5 years. So that would be, let's say, 10 to 20% growth. I'll hide this calculator. And you can see here you can hide this right here or expand it, but it shows kind of what this looks like. So on the low end, they would grow to about $6.40 per share by year 5, and then the high end, $10 a share. And this, I think, is a little more realistic. Basically, what it's showing is that based on these growth numbers and a starting free cash flow of $4 a share and the long term of 0 to 2%, discount rate of 12%, that sort of thing, the median output that's calculated is 64, or call it $65 a share right here. This is the current price. And then this is the current price divided by 1 minus your margin of safety. This is a way to show you value zone and deep value zone, if you will. But once again, just look at this. Let's say that we make the spread up to 50. So let's say you want to account for the high end, but you don't want to commit to it. This is a good way to do it. So it pretty much tells you that, hey, based on the numbers you put, if it's evenly distributed here, you're looking at it being overvalued in about 15% of the scenarios. That's like, whenever it's closer to 10, and then super deep value in like 60% of the scenarios, which we talked about. 50% is a no-brainer if you think it's going to do that. I'm going to split the difference a little bit. I'm going to put 25. So, and ironically, this is exactly what it's at right now. My median output is like exactly what the current price is. And what you can do is save this. And so I'll do Uber video and then put some notes. So growth 10 to 25%. If it grows higher, it becomes a no-brainer. Yes. Okay. So we have that. And real quick, you can go to my valuations up here and it shows you, these are all the other videos I've done since I released the software. And here's Uber. And I have it sorted from what did my model say versus what the price is now. So, at the time, whenever I did the Adobe video, the price was $193. The model spit out $220, which now it's $237. So it might be time to trim that a little bit. But that's the beauty of this, is that it's like a log of all of your work, all of your evaluations, You can expand it, see what you wrote, see what you put in, what your assumptions were here. It's great. I use this as much as anything, especially if you save it, come back to it 2 or 3 months later, because the story behind a stock or the retail sentiment can change, but it really helps to come back and say, hey, what did I think back then, and read your notes and help you make a rational decision. So anyway, for me, Uber is going to be, it's on my watch list. I'm really paying close attention. I would love to see it fall because I think it's a great company. I might start a small position if it gets in the 60s, let's say, but really this is one, it's kind of like on my wish list, I call it. I have my watch list, then I have my wish list, which is, these are great companies, but it needs to fall, and then I'll be excited. So anyway, that's all I have. I hope you enjoyed the video. Check out the website. Have a great day.